All right, guys, what's going on? This is Ryan, aka Cantor & Clark, and in this video, I just want to demystify the concept of funding. So there's a lot of misinformation and misunderstanding. So hopefully this will clear that up, and we could talk about, what it is, what the purpose of it is, how it differs, or rather, how perps differ from traditional futures contracts, and then how we could potentially go about using this within our trading strategy. So in traditional futures contracts, normally, normal markets, normal market conditions, normal market environment, markets will be in contango. So we'll normally find that, how many times can you say normally? We'll typically find that the futures prices will be trading at a premium with relation to the spot prices. So this means that the spot price is below the futures price, otherwise referred to as a negative basis. So this is for a host of different reasons. But just to make it simple, so it's easy to understand, imagine if you get into a contract to buy something, but you don't want to take delivery of it yet. Okay, you want to buy it at a future date. All right, now the seller is passing up on selling it right now, right? So by passing up on it, that's opportunity cost. All right, by not selling it immediately, they have to hold on to it for you. So you're essentially paying for storage fees and cost of carry. So just to put that in very simple terms, all right. Then there are cases when the market is in backwardation, say we're in a period of supply shock, and think about crude oil, for example, and this will mean that the futures prices are trading below the spot instrument. So in the near term, across the curve, the spot price will be above the futures price. So with the perpetual swaps, they're not traditional futures contracts. They don't have an expiration. They don't have a fund. They don't have a settlement date. Essentially, they're synthetic derivative or synthetic futures contract that constantly settles along the spot price. Okay, so they have to track the spot instrument. So on the futures exchange or on Bybit, on BitMEX, traders are trading with larger position sizes than they would typically on the spot exchange because they're employing leverage. So just think of it about this as traders having more gunpowder, more fuel for their positions. So what we typically see is that the perpetual swaps will swing to the upside and to the downside much more than the underlying spot instrument. So over time, if you look at this chart right here, you'll see that Bybit's price is in black, and I just have, for simple sake, I have Coinbase price in red. So you'll see that sometimes Bybit is above, sometimes Bybit is below, all right? But with the perps, these kind of have to stay, they don't kind of have to, they need to stay pretty much hand in hand. So like I said, though, on the exchange, traders are going to be using more leverage, okay, or rather they're going to be using leverage, whereas on the spot exchanges, unless the exchange offers margin, they're just going to be trading spot. So larger positions move the market more, all right? And when the market moves more, okay, there is a either positive or negative basis. So again, the basis is the spot price minus the futures price. So if there's a positive basis, okay, this means that the spot price is above the futures price. So say there's a large sell-off, all right, typically what we'll see is there'll be a positive basis or the futures trading at a discount with relation to the spot. Because on the exchange, there are more traders, okay, one being liquidated, all right, you don't have that on the spot exchanges, okay, so they're being liquidated out of positions, okay, they're using larger positions in general, so prices will swing to the downside more. Same can be said in the opposite event, that prices are moving up, right, with tremendous velocity. Traders are aggressively lifting the offer. In this case, what we'll see is that the futures contract will be trading at a negative basis or at a premium, rather, to the spot instrument. So again, the funding rate is actually something on the peer-to-peer exchange to incentivize participants to move the price back, right, hand in hand with the underlying spot instrument. So when there is a basis, okay, or whether it's a positive or negative, so let's just say that there's a negative basis. So let's just find an example on the chart real quick. Okay, the Bybit line is black, so let's look over here. All right, so right here, you'll see that Bybit is below the spot price. Okay, so this is a positive basis. Okay, so in this case, if this was to be prolonged over a period of time and there was this discount, okay, so in other words, the futures price were trading below the spot price, we would likely see that if this was becoming the popular trade, let's say the market is moving down, all right, aggressively, everyone's jumping in short, okay, they're aggressively jumping in. It's not that there are more shorts than there are longs, okay? It's a futures exchange. The only time you can argue that it's not a zero-sum game in markets is if you're arguing that equities are a positive sum game, because each side is gaining something. But on the futures exchange, it's truly a zero-sum game. For every long, there's a short. But there are times when there are traders more aggressively buying, okay, or more aggressively selling, because remember, there's two types of order flow. There's passive order flow and there's active order flow. Active order flow implies that, if you're buying actively, you're aggressively lifting the offer, meaning you're taking liquidity. The opposite can be said for selling, hitting the bid with a market order. Okay, so aggressively selling. So in the case where we have something like a positive basis, right? So the futures price is trading at a discount to the spot price, meaning it's below. Over time, this would typically lead to a negative funding rate, all right? It's a peer-to-peer exchange, okay? One side pays the other. So it's sort of like an interest rate, but it's not the same as margin. So it's not like they're constantly paying this. They're not paying this every day. It's just they're paying it at the end of an 8-hour period. All right, they can get out of position. They don't have to pay, and they get right back in if they want. But if they hold a position, they have to pay. So when the market or the futures price is trading at a discount, so it's below the spot price, and the funding rate is negative, okay, longs get paid. Okay, shorts have to pay. So just think about this and what that implies. It implies that the futures price is trading below the spot price. So what would get the prices back in line? Well, if longs opened up positions, all right, aggressively, that would move the price back up. Okay, and if shorts closed out positions, that means they buy back in to cover. All right, if they closed out positions, that would move price back up as well. So again, this mechanism is employed to incentivize traders to take the opposite side of the market and move the price back. And this is settled with this is essentially settled with a TWAP, or rather it's applied with a TWAP over 1 minute intervals, I believe. And essentially the basis is constantly being calculated in order to keep these two prices in line. So it's not a matter of being a ratio between longs and shorts. All right, for every long there is a short. Okay, what it shows us is where potentially the market is positioned dominantly. So you could consider this also a gauge of sentiment as well, because what you'll see is when the market is extremely bullish, we'll have a prolonged period of a positive funding rate, okay, and typically the futures contract will be trading at a premium to the underlying spot instrument. So it'll be trading in excess of, or it'll be more expensive. Just think of it as a premium as it is more expensive, okay? So when the market is, moving on the up and up, okay, what is the popular trade to take, right? It's to buy dips, all right, it's to hang on to your longs, okay, but it's a peer-to-peer exchange. So in some way, they have to get someone to take the opposite side of the market. So again, whether it's a extremely high premium, okay, or rather, in that case, a negative basis, okay, or the opposite, which is an extreme discount, okay, this could potentially give us signs as to where there might be potential reversals, okay, where traders might be trapped, all right, where traders might be crowded. So just to give you some insight into how you would use this, if you combine this with any type of order flow analysis, whether we're looking at cumulative volume delta or passive versus aggressive order flow, or just delta between active order flow. If we're looking at something like this up here, okay, this pre-breakdown, all right, this pre-breakdown, we looked at this pre-breakdown, all these moves where we shot up, okay, what we typically had was, we had, in this case, we'll just use this for example over here. We had a premium, we had a positive funding rate, and it was increasing. Okay, open interest was increasing. Longs were entering in aggressively, anticipating that price was going to continue up bullishly. All right, but we saw that there was that divergence between actual price action. All right, so what does that give you some insight into? All right, traders are aggressively trying to long, okay, meaning they're lifting every offer. All right, the funding rate is increasing, the premium is there, okay, meaning the futures price again is above the spot price. All right, but price is doing nothing to resolve upwardly. So this gives us some insight into where the market is crowded, and crowding leads to liquidations, because when everyone is crowded in one position and price is not resolving in that direction, they only have one thing to do. If there's no one left to long, everyone tries to go for the exit, and you see these areas where we range for a prolonged period of time and then we liquidate and move to another range. And typically this is how Bitcoin behaves when it's not trending. It basically establishes these brackets or these ranges, and it goes from one liquidation to another range and one liquidation to the next range and so forth. So again, to clear this up, it's a mechanism used by the exchange. Okay, it's created by the exchange rather to keep these prices in line. So when you talk about the index, it's a compilation of Oracle exchanges, so multiple spot exchanges. And the derivatives contract, the perp swap, because of the larger position sizes, okay, because of the increased gunpowder and more aggressive trading, it will sometimes swing beyond, or rather detach itself from the underlying spot index. All right, and that's that. Okay, it's not a ratio. It's not more longs than shorts. It's just an indication as to what where potentially the market is positioned aggressively. All right. So if you're looking for the funding rate, it's pretty easy to find. You can go onto contract details onto each exchange. It's pretty obvious. But that just gives you what the next value is in the current value. If you want, you can actually go onto TradingView, and the neobutane indicator is fantastic. It shows you not only the funding rate and how it's changing, but what the current premium or discount is. So you can chart this historically. You can see what the trend is, how this relates to tops and bottoms. Again, you could use this to substantiate. I really couldn't get that word out. To either further your case, okay, for potentially picking out the turning point, or substantiate a case for, like I said, reversals, melt ups, not melt ups, rather, long and short squeezes, all that fun stuff. Okay, positioning is everything when there are when there are no real new inflows coming into the market, and BitMEX is leading the market as we see constantly. Essentially, it's just you and I. We're trading against each other. So when we could find areas where price is ranging, okay, and one side of the market is really crowded in a corner, all right, there's really only one area left to go. And again, whether it's shorts or longs rushing for the exit, doesn't really matter. It resolves explosively. So pay attention to open interest, pay attention to funding, pay attention to premium and discount, and these things can really tremendously help your trading. So that's that, guys. This has been a pleasure. Excuse me for my my errors, but this is a one-take kind of thing. So as always, guys, this is Ryan, aka Kendrick Clark, signing out. Exercise proper risk management and trade effectively.